You ever see a headline that looks super simple on the surface, but you just know there's a way deeper story hiding underneath? Well, that's exactly what we've got today. It starts with what looks like a straightforward banking decision, but it quickly spirals into a financial mystery with a bunch of different players, totally conflicting stories, and yeah, some pretty high stakes. Let's dive in. So this is what kicked it all off. This headline drops on December 26th, and at first glance, it seems to connect all the dots, right? You've got one of the biggest banks in the world, JPMorgan Chase, and what looks like a clear-cut case of enforcing sanctions. I mean, it makes total sense. A huge U.S. bank has to take action against companies working in a sanctioned country. But yeah, not so fast. The second you start to peel back the layers, that simple, tidy story just completely falls apart. What looked like an open and shut case is, well, anything but. Okay, so let's get the players straight. We've got two fintech startups, BlindPay and Contigo, and their big focus is Latin America. Now, what's really key here is they weren't banking directly with JPMorgan. Nope, they were connected through a middleman, a payments partner, and that relationship is super important because when JPMorgan brings the hammer down and freezes the accounts, it sends a shockwave through this entire chain. And then, boom. We get the first major plot twist, and it comes directly from JPMorgan Chase themselves. They come out and flatly deny it, saying this whole thing has nothing to do with them being stablecoin companies. And just like that, our simple story hits a massive brick wall. And to prove their point, JPMorgan basically says, hey, look, we're not anti-crypto. We work with other stablecoin businesses all the time. We even just took one public. So that denial forces us to look past the easy answers. If it wasn't about sanctions or crypto, then what in the world was it really about? Right. That question is everything. And to find the answer, we have to turn to the next key player in this whole drama. Remember that company in the middle, the one that acted as the bridge to the bank? Well, get ready because the narrative is about to take another really sharp turn. So let's hear from Checkbook. They're the digital payments firm, that critical link in the chain. And surprise, surprise, they have a completely different explanation for what went down. Now, to really get their side of the story, you've got to understand this one key term, a chargeback. Put simply, it's when a credit card company yanks money back from a business, usually because a customer disputes a charge or there's fraud. And for any bank or financial company, a whole bunch of chargebacks is a huge, flashing red light that screams risk. So, according to Checkbook's CEO, the problem wasn't politics at all. It was just pure old-fashioned risk. He claims there was this sudden, really alarming spike in chargebacks, and they were all coming from new customers signing up with BlindPay and Contigo. From JPMorgan's point of view, that probably looked like a fire they had to put out immediately. And what's really interesting is how the CEO, PJ Gupta, frames it. He's not exactly accusing them of doing something malicious. It's more like he's saying they just grew too fast without the right controls. They opened the floodgates, and all this risky activity poured in. That kind of chaos is something a buttoned-up bank like JPMorgan was never going to tolerate. But just when you think you've got it figured out, it was risk, the story twists. Again. Because now we hear from Contigo, one of the startups caught in the middle of this whole thing. And let's just say they do not see it Checkbook's way, not even close. And this slide just lays out the conflict perfectly, doesn't it? On one side, you have Checkbook pointing the finger, saying the startups were the problem, too much fraud. But on the other side, Contigo is pointing right back, saying, no way, the operational problems were on your end with your platform. It's a classic case of he said, she said. And Contigo is not just denying these claims, they're actively fighting back. They're pushing back hard against any suggestion that they were moving money without proper ID checks. They insist that the real issues they faced were because of problems with Checkbook's service. They're even taking legal action. So yeah, they are not taking this lying down. So let's just zoom out for a second and look at this timeline, because none of this happened in a vacuum. You've got this backdrop of Venezuela reportedly using crypto to get around sanctions, which raises the political temperature. Meanwhile, Checkbook is growing and lands this big partnership with JPMorgan. And then, a little over a year later, the freeze happens. Each one of these steps adds another complicated layer to the story. So at the end of the day, where does this all leave us? We're looking at 4 competing explanations for the exact same event. The first reports pointed to Venezuela. JPMorgan says it has nothing to do with stablecoins. The partner, Checkbook, blames a surge in chargebacks, and the startup, Contigo, blames the partner. Everybody has a different story, and everyone is trying to protect themselves. So what's the real takeaway here? The truth is, it's probably not one single culprit. It's almost certainly a messy combination of everything. You've got geopolitical risk from operating in a sensitive region. You got real operational risk from a spike in fraud. And you got huge reputational risk for a bank like JPMorgan. It was a perfect storm, and they just pulled the emergency brake. And honestly, this story is way bigger than just these few companies. It's a perfect snapshot of this massive clash happening in the world of finance. You've got these giant, slow, incredibly risk-averse banks on one side, and on the other, you have these innovative, scrappy, fast-moving startups trying to change the game. When you throw them together in a high-risk part of the world, well, friction isn't just likely, it's pretty much inevitable. And that really leaves us with a final, big question that goes way beyond this one case. When the rules of old money slam into the ambitions of new tech, who are the ones that end up getting caught in the middle? It's a question about the entire future of finance, innovation, and ultimately, who pays the price when these two worlds collide.